You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner, where we make investing as simple as possible. Here at the Cash Flow Academy, we're excited to have so many listeners, and we congratulate you for tuning in. Today, my guest is very special. He is an author. His name is David Stockman. I'm going to have him introduce himself a little bit. I was introduced to David's work by a book he wrote called The Great Deformation. And as many of you know, I spent about 15 years traveling the world as a rich dad advisor with Robert Kiyosaki. And in our book studies, we would choose books to stay together. We'd get together for about 3 days and study a book. We'd read it for 6 months and then get together and talk about what we had learned. And we had chosen David's book, The Great Deformation, of one of our books of study. So I was introduced to his work years ago. And David has a new book that I'm really excited about. It's called The Great Money Bubble: Protect Yourself from the Coming Inflation Storm. So with that, I welcome and give my appreciation to David Stockman. Thanks for being on the show.
Very happy to be with you. And I have to say that I understand why you studied The Great Deformation for 3 days. It was 640 pages long, and at least I've gotten a little wiser since then. The current book, The Great Money Bubble, is only 220 pages long, but updates what I was talking about back then.
Well, and I also think that the wonderful thing about this book is, while it's still a really good dive, there's a simplification, and I think this is really for whether you're a real macroeconomics, politics, monetary policy buff, or if you're a person concerned about how inflation is going to affect you and how to protect yourself. I think this is written for a very broad audience, so really excited to share it with the audience. David, give us just a little bit of your background. You've been involved in the, in high levels of the political world, I guess you could say. But tell us a little bit about your background and what brought you to have an interest in this topic.
Well, let's say I've been at this a while. I started working on Capitol Hill as a young man in 1970. I was a congressional aide for few years. I ran for Congress in 1976, was elected before I was 30 years old. Thought I would be in Congress for a while, and then got called to be OMB director, Office of Management and Budget Director, by Ronald Reagan. I helped shape what we were trying to accomplish then, called the Reagan Revolution, redirection of government and fiscal and monetary policy. After that period, because we didn't really achieve what I thought our intentions were, I went to Wall Street, became part of Salomon Brothers, which was a big bond trading house at the time, and then I helped found Blackstone Group in the late 1980s, and eventually my own fund after the year 2000. Now I publish a daily newsletter on everything that's happening on both ends of what I call the Acela corridor. In other words, Wall Street on the New York end, and Washington, politics, policy, fiscal matters, even international and foreign affairs matters on the Washington end.
You mentioned your newsletter. People can find that and learn more about it at www.davidstockmanscontracorner.com. And it's always great stuff. And what I love about David is speaking from a person who's been on the front lines. And you mentioned the Reagan administration, and that might be a great way to dive into the inflation we faced recently. Carter had a very difficult presidency. Aside from the foreign policy with Iran, it was really the economy, and Reagan just wins in a landslide. Paul Volcker is aggressive with raising rates, and this is 40 years ago. And are there any similarities? What are the differences between what we're falling into now and what we saw in that Reagan administration? Personally, I think it's very different, but I'd like your take.
Yeah, well, that's a great setup. And yes, there are some similarities, but there are profound differences. I address them actually in my book. I have a chapter called Not Your Grandfather's Inflation, which using that as a metaphor for the 1970s. So I try to lay out the sweeping number of differences between then and now, but the heart of the matter is that in August 1979, Volcker, out of desperation, I think, at the White House, Jimmy Carter White House, was picked to run the Fed. He was a solid, sound money, anti-inflation guy and went to town doing what needed to be done. The inflation rate was running 12, 13% then. He inherited a interest rate market in which all interest rates were below the inflation rate. So you had negative real rates, essentially subsidized money, and it was no wonder then that inflation kept building because people were being paid to borrow and speculate. Volcker saw through all of that, and rather than negative 2% yield, that is after inflation on the 10-year bond, which is what he inherited, by mid-late 1981, 2 years later, the yield was positive 9%. In other words, the yield was 9% above the inflation level, which was very high, but he was bringing down. So he basically said, we're going to have to put the economy through the ringer. We're going to have to basically wring out all of this excess liquidity and speculative borrowing that had infected both Wall Street and Main Street and get the economy back on a firm footing. Well, actually, it worked out. People probably don't remember this, but by 1983, what had been a 12 or 13% inflation rate, actually at the peak it was more like 16, was down to 3 or 4% on its way to 2% or under. So Volcker did the job. Now, yes, there was a big recession in 81, 82, but the economy then bounded back strongly, and for a period of time we had non-inflationary prosperity during the 1980s. The difference today is that Jay Powell is no Volcker. There's this famous thing in the 1992 presidential campaign, or vice presidents were debating, in which the Democratic presidential or vice presidential candidate said to Dan Quayle, I knew, he was compared himself to John Kennedy, and the candidate, which was senator from Texas.
You're no John Kennedy.
I knew John Kennedy, and you're no John Kennedy. Well, I knew Paul Volcker pretty darn well, and this guy is no Paul Volcker. He is making a more aggressive effort than I expected to deal with this problem, but it's way too late because he deluded himself into believing that inflation was transitory and that it would go away on its own accord. It didn't. Now, the key thing, though, is that unlike the Volcker Fed, we have had successive Fed chairmen who've had their foot on the accelerator for years and years and years. It's measured by the balance sheet of the Fed. No matter how you slice it, the balance sheet reflects how much credit is being created. And by created, I mean, pulled out of thin air by the Fed over time. And when you look at even the crisis in 2008, which we thought was going to teach people a lesson about sustainable economics and sound money and fiscal policy, but if we go back to the eve of the crisis in early 2008, balance sheet of the Fed was only $800 billion, pushing 900. It peaked at $9 trillion a few months ago. So in that relatively brief period of historical time, the balance sheet of the Fed went increased tenfold. I mean, just crazy amount of fiat credit and liquidity being pumped into Wall Street. That inflated the hell out of the stock and bond market. Eventually, that made its way into the global economy, and finally to the gas pump and the grocery store and the 40-year high inflation that we're dealing with today. So the big difference is a totally different Fed. a Fed that basically lost all common sense when it comes to running the printing press down there, as I said once, in the basement of the Federal Reserve.
At the risk of, I shouldn't do this to our listeners, but I think they're sophisticated enough. There's really, when I think of that Fed balance sheet, I think of four accounts. I think of the money in the currency in circulation. I think of the deposits held by member institutions. I think of the reverse repo agreement part of this, and then of course the checkbook of the Treasury. And it is breathtaking. Frankly, to start around 2008, when in that crash, there were major changes to policy where now the Fed would pay interest on deposits. And the amount of money that was printed but held as deposits just ballooned like crazy. They tried to, you can see several times they try to level it off over time. And then in 2019, oddly enough, before the pandemic, they started to loosen again. And of course, the pandemic just opened the floodgates. And if people see the ratio between the amount of money in reverse repo, the amount of money on deposit versus the amount of money in circulation, if that money continues to leak into circulation, I just think we're not even close to getting hold of this inflation. What are your thoughts? Do you think they get a handle on it with this, or do you think it's going to, the amount of money that still is there to leak, that has been present, to leak into the economy or potentially do so, to me, it's breathtaking.
Yeah, that's a very good point. It gets into a pretty sophisticated level of analysis. But the point is, from my point of view, you need to look at the Fed liabilities because they end up somewhere, and if they don't end up in Main Street pocketbooks the next day, resulting in a enhanced bid for goods and services, which eventually generates inflation. Mm-hmm. They work their way through the complexity of the financial system and the global economy, and sooner or later come out in the wash as goods and services inflation, even as on an interim basis, you end up with financial asset inflation. So I look at the liabilities. They peaked at about $9 trillion. It's down to maybe $8.7 trillion today. But these are gigantic numbers that basically put the system at risk. And even though a lot of that came back to the Fed's balance sheet in the form of that repo facility that they stood up, the fact is that banks actually can use the collateral that they have at the Federal Reserve, that is the so-called reserve deposits. They can use that as collateral to borrow money in the private market and fund the whole inflation cycle as they go. So the idea that somehow the reserve deposits are inert or sterilized is just wrong. They're part of bank balance sheets, and it's what banks use in order to extend their own leverage. So we have a system. I think the better way to look at this is to measure the total amount of debt that's out there, because sooner or later, when the Fed creates liabilities, it ends up, especially when it pegs interest rates at rock bottom below inflation levels, that is at negative real rates. When that happens, it ends up in debt on public and private balance sheets. And what we have today in the U.S. economy is $91 trillion public and private debt. Everybody knows about the $31 trillion at the Treasury. That's federal Uncle Sam's debt. But if you add in households and businesses and the financial institutions, it's $91 trillion. That's 3.6 times GDP. Let's call that the leverage ratio of the national economy. The leverage ratio back in the good old days when we had a healthy, balanced, sustainable, prosperous American economy, let's say 1970, was 1.5 times. It had been 1.5 times for decades and decades, even going back to the 1870s. So when we went from 1.5 to 3.6 leverage ratio, we actually added 50 trillion of excess debt to the U.S. economy. In other words, if we were back at the sustainable leverage ratio that had worked so well over a long period of time, we would have about 37 trillion of debt today, not 91 trillion. And it's that difference, which is the real subtle, it's not so subtle, but it's the dimension of this money printing spree that needs to be brought into the equation, because all of that excess borrowing originally funded spending and investment that bloated and distorted a lot of markets, and now it's creating a carry cost in terms of debt service that is insuperable, because everybody thought interest rates would never get off the floorboard. And obviously now they're going up, and they still have a ways to go if the Fed is going to get any handle on inflation. So we were living in a false world of 91 trillion of debt, but very little debt service. And now we're going into a world where the debt service on that 91 trillion of debt is going to become a huge burden to the economy, roadblock to continued expansion. Just remember, 100 basis points of debt increase on average, 1 percentage point, adds about $1 trillion to the carry cost of all that debt on the U.S. economy. And that affects behavior, let me tell you. That will cause a lot of unwanted things to happen.
Biden talks about a soft landing or a soft recession, I suppose. I think this will be a sticky inflation. I heard, and I don't know if this is true. I mean, people throw these statistics out that you've never had significant inflation of this size without raising the rate above the inflation rate. In other words, the Fed has to go above the inflation rate in order to get this. I don't know if that statistic is real, but it seems to be logically plausible. Yes.
It's not only plausible, it's demonstrated historically. When Volcker took over in August 1979, we were facing 13%, I think, on the CPI year over year. The real rate on the 10-year, which I use as the benchmark, that's kind of the core security that establishes the price of everything else through spreads. But anyway, the real yield after inflation was negative 2.5%, and Volcker said this can't be. We're subsidizing massive amounts of unsupportable borrowing and speculation, and we're not going to bring the economy or the inflation to heel until we get into positive rates. But the momentum was so great that by the fall of 1981, and I was in the middle of that then in the Reagan administration, the real rate had been pushed, if you can imagine that, and that's why all this caterwauling today about they're raising rates too fast really, is consternating. The real rate was 9% after inflation. Inflation was still 4%, so I think yields were still like 12 or 13%. That's what Volcker had to do to finally break the back of the price, wage, cost, inflation spiral that had been, fostered during the 1970s. And the idea that somehow we're going to get to 5.1%, which is the latest dot plot that came out yesterday, and they'll be done, I think is very naive. I think it's inconsistent with history, and that even the short-run overnight rate, the so-called Fed funds, is going to have to go quite a bit higher, 2-3 percentage points or more higher, before we finally bring inflation to heel. And the idea that inflation cooled down from 7.8 to 7.1 is no small consolation. I mean, you do the 7% a year for a decade, and you've crunched the value of both paychecks and savings accounts. So you can't do that. They have a long way to go. In fact, this idea that inflation is cooling rapidly and the Fed ought to ease up, I think is so completely wrong. If you look at the CPI we had this week, and I think, all the headlines were, well, look, the corner's been turned. No. If you look at services, domestic services, which are 60% of the weight in the CPI, and the one thing that the Fed maybe can affect directly, it can't affect the price of oil internationally or even the price of goods sourced in China and Vietnam and Mexico and elsewhere. But if you look at domestic services, which are more sensitive to Fed rate and other policies, the increase was 6.8% year over year, the highest level yet, and the highest level in 40 years. So that's really what the relevant number that came out of the November CPI this week was that in services inflation is still got a huge head of steam, and the Fed isn't even close to winning the battle or being in a position to pivot as Wall Street keeps praying for.
So this leads us to a simple question that's obvious: is okay. If I believe there's still massive amounts of money on the Fed's balance sheet that can leak in the economy, if I believe you mentioned, it's not the 30 trillion, it's the 90, and then you think about the promises we've made, the unfunded liabilities that it's social programs, Medicare. I mean, this is in the hundreds of trillions. As this is brought to bear, if we have runaway inflation, I'm surprised that things like gold have not already spiked more. I'm very surprised at that. People speculated that crypto would be a hedge against inflation. That's been demolished. For me, I think in my financial statement, it's actually the debt that I have that's actually been a positive because obviously you're going to pay things back in cheaper dollars. So I've really liked debt as a way to manage this, and that's very difficult, I think, for a lot of people to understand and say, wait. The debt you've used to buy assets has been the biggest benefit. It has in reality. Well,
these are good points, but I think you have to go back to basic economics 101 and recognize that for every dollar of debt out there has to be either a dollar of savings or B, a dollar of fiat credit produced by the Fed and other central banks. If you go the B route, you're going to get inflation down the road and you're not going to accomplish anything. If you look at the A route, then for every cheaper dollar somebody's paying back, there's a saver who's getting savaged.
Getting sacked.
Inflation and the shrinkage of his principal amount. Now, the economy desperately depends on a healthy level of private savings sustained over time in order to fund investment both in productivity creating activities as well as growth capacity. And we're now at the lowest savings rate on the personal income side that we've seen in 50 or 60 years, if ever. And we have finally a Fed that said we're not going to print any more money. We're going to basically shut off our printing press and go to QT after all these years of QE. QT is the opposite of QE. Instead of buying money with fiat, buying debt, government debt, and mortgage-backed securities with fiat credit, they're now going to be running down their balance sheet, effectively selling it. Technically they're just letting debt they own mature, and therefore it will have to be replaced in the private market. But it's the same thing as selling. So they're going to be selling $95 billion of debt a month, whereas before they were buying 120. Well, that's a huge reversal. They've had to do it. I don't think they were all that keen on it. They were all that excited about it, but they had to do it in order to get inflation under control, and that is going to profoundly affect the financial system as we go forward.
Boy, you made a salient point there about a balance between a dollar issued to someone as a loan as a result of some type of fractional reserve that is held by a bank. some saver. And, it was funny. My father's not a sophisticated investor. He's getting older. And I said, Dad, at a minimum, look at your I bonds because they're paying 9% now. And he goes, 9%? Really? I says, Dad, that means if your investments aren't making 9%, you're not keeping up with inflation. Your savings, your little wad of money under your mattress is getting crushed right now. And that won't return. I mean, the thing I think people think, oh, inflation's back down. The prices didn't go down. The rate of growth of the runaway train was slowed, but the train is still where it is, right? It's gone down the track. They've lost this money.
Yeah, that's exactly right. And one of the dynamics which we learned about during the 70s and I think then because of this phony period of so-called lowflation in the last couple of decades, we unlearned, and especially the people at the Fed, but also Wall Street, is that inflation is cumulative. And therefore, we have been seeing prices rise at faster and faster rates ever since about the spring of 2020 at the bottom of the COVID lockdown craziness. Now, when you add that all up, it means that people are increasingly behind in terms of the purchasing power of their wages, and they're not going to take it sitting down. In other words, there is a impulse in the economy for workers to try to catch up with all the ground they've lost since their last pay increase to inflation in the interim. So that's why, frankly, for once, the Fed's got its head screwed on a little bit right, and they're focusing on the services and wage side of the domestic economy because they know there's a lot more pressure to come before we finally turn the corner. And that's why I put such a big emphasis on looking at the services components of the CPI and the fact that we were at a record level in November. We weren't seeing the inflation cooling. We weren't recording any abatement of the trend. In fact, it was the highest level yet.
Fascinating stuff. Two things, and then I'll let you go. First, the idea of protection. If a person is not a macroeconomist and he's not a nutty, I'm not an economist, but I'm more of a hobbyist. I do take deep dives into these things. Some people say your first book at so many pages might have been doorstoppish. To me, it was like a Thanksgiving dinner. So I loved it, and I had the piece of pie after. New book is wonderful as well. What'd you say to the person that is more excited about your 200-page book? What are the keys they'll find in there on protection when they read it?
Well, the first thing is to understand that the environment is reversed, it's changed drastically, the party's over, so therefore the casino, which was a place for a windfall, the casino, by that I mean Wall Street, the stock market, the bond market, had been a place for windfall gains and fabulous riches, double, triple your money if you bought the right, soaring tech stock. That's all over and done. They're going to tell you the bottom's in. It isn't. So we're now in a era which may last for several years where the important priority is capital preservation, not capital appreciation. And so therefore, you stay out of the casino, even though it might look tempting. And by that, I mean both stocks and bonds, the S&P 500, the tech stocks, and longer-term treasuries are all still overvalued. You're going to lose money if you get in now. Secondly, people need to understand that if they've got some winnings because they bought the right tech stock, Tesla, although it's fading by the day, now's the time to cash out and pay down debt. We're going to be in this inflation storm for years to come, and interest rates are not going to go down, not next year or the year after, or for a long time to come. So paying down debt is probably the most important financial step that people can take, either because you spend less and have more income to apply to your balance sheet, or you cash out the winners and pay down the debt. And third, we're going to be in for tough times, and therefore it's necessary to tighten the belt. Now, it's unfortunate. People don't deserve to be in an austerity environment, because the people didn't create this problem, the politicians and the central bankers did. But in terms of practical advice, what do you do with the hand that we're being dealt? You spend less, if you possibly can, on discretionary items, and try to build up cash or pay down debt in order to hunker down for the storm ahead.
It's fascinating stuff to read for sure. The last thing I'd like to ask you about is something I often ask my guests as a final question. I love their opinion on financial education in two ways. For example, I'm not selling my stocks at all. I invested, I had another round of heavy investing during the coronavirus pandemic, and I felt I got some really good prices on stuff. And I don't really care about the ups and downs capital gain wise. I love dividends, and I love covered calls, and I love cash secured puts. And by doing that monthly, a very simple education, I reduced that cost basis further. I'll give you one of the ones I teach my students a lot is, right now Dow Chemicals at 50. I bought, it's been as high as 70. I bought it at 40, but my cost basis after $7 of dividend on that time per share, and about $15, $16 of call writing, basic stuff you do at an IRA. My cost basis is probably around 2019, something like that. And so I really like, I don't really care about the ups and downs, because I love the cash flow. I love being a business owner and collecting a dividend. And, if that's paid off in 5 years, what do I care what the price of it is? I recompound the dividend. But the bigger point of that is most people don't have, like a lot of our listeners are sophisticated, but I think people outside of our group wouldn't even know the first thing we're talking about, particularly your comments on the Federal Reserve balance sheet and the different types of debt and words like CPI. It's all gibberish to them. So from a survival standpoint, I like your thoughts on financial education in this day and age, and how it's not taught in school. And then I'd also, from the point of the electorate, we have an electorate. I'm apolitical. A lot of my friends have leaned more to the right lately, but I'm very apolitical. I really don't feel it's in my control, so I just invest. I just want to know the rules of the game. But as a practical matter of their own survival, and also as a practical matter of having an electorate that kind of gets this stuff, what is the role of financial education in this time that we're facing that I think is unprecedented?
Yeah, well, the first thing I think that's really important is you have to pay attention to time. Listening to you describe what you have been doing tells me that you have very successfully capitalized on or exploited the bubble to good effect in terms of balance sheet enhancement. The thing that I have to tell people today, though, is if you didn't do that, if somehow you didn't see the opportunity, now is the wrong time to enter the market. You don't buy high and end up panicking and selling low. That is a way to go to the poorhouse very quick. And now we're in an environment where it's dangerous to buy stocks and bonds with fresh money, because the probability that things are going to go down in a big way, I think, is very strong. Secondly, you can't get enough economic education, and you're not going to get it from the mainstream media, period. It's appalling to me, because back in the day when I was starting, you could count on the Wall Street Journal or Business Week back then, or Fortune, to convey solid economic and financial information. It has gotten so bad that basically the Wall Street Journal has become a mouthpiece for the Fed. And go back and grab yourself a copy of the September issue of Fortune, and you will see Sam Bankman-Fried on the front cover with a caption that says, "The new Warren Buffett?" ? All right. You are not going to be educated by the mainstream financial press. You've got to look for alternative suppliers who take a more sober and more sort of basic fundamentalist view of economic and financial matters.
on that note, I recommend The Great Money Bubble as part of your financial education. Protect yourself from the coming inflation storm by David Stockman. I feel like I'm the luckiest guy in the world that I get to do what I do as a teacher every day. I didn't become a teacher because 30 years ago, I was beating Warren Buffett in investing contests. I became a teacher because I was fascinated as a student in the topic, and we seem to have a knack for making it simple, and we hope we have the ability to simplify it here on the Cashflow Academy. Again, the book is The Great Money Bubble. Protect yourself from the coming inflation storm. You can find information on David's newsletter at www.davidstockmanscontracorner.com. This has been the Cashflow Academy podcast. We hope we've helped simplify. There's a lot of debt. There's a lot of money printing. That causes inflation. Time to get educated. It is that simple. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.